Hi everyone, welcome to this webinar around the world of ocean freight. We're going to recap 2022, which was another crazy year in shipping. We started the year coming in with way more demand than supply, and we're exiting the year with a reverse trend, way more supply than demand out there. My name is Schulze. I'm the global head of ocean freight here at Flexport, and I'm super excited to spend the next full hour with all of you. Before we get into the details, as usual, a big fat disclaimer right here. Whatever myself and the panelists convey today is our opinions right here, right now. Please don't hold us accountable for any of it. It's a very dynamic world out there, ever changing. So take it for what it is, including the predictions we're going to put in front of you. I'm here today with two super cool co-speakers, Lars and Patrik. Before I get into introducing them in a minute, just a few practicalities around the app for the ones of you that haven't been with us for a webinar before. So in the top right corner of the app right here, you see a chat box. In here, you can post any questions that you feel we're not addressing throughout the interaction. We have a few Flexporters representing, so they are ready at their fingertips to basically address any questions that pertain to your supply chain. Then we also have the opportunity to basically download the deck that we present you with today in a PDF format, so you can share it with colleagues, friends, and family for that matter. And then I know Patrik also has some very recent insights that we didn't get the opportunity to incorporate in the slide deck that he will share as well, so you all have that. But nevertheless, let's get into it. First off, welcome to you, Lars, CEO and partner of Vespucci Maritime, which is one of the leading ocean consulting advisories out there.
Thank you, Anders, for bringing me back.
And Lars, for the record, you don't get the opportunity to introduce yourself because you've been with us for too many times. Different story for Patrik. The first time, Patrik, you're joining the panel. Super excited to have you with us today. Patrik is CEO and co-founder of Xeneta. But Patrik, tell us a little bit more about what Xeneta is all about.
First and foremost, thanks for having me on, and Anders, really appreciate the opportunity, and hello to everybody. So Xeneta is the market-leading intelligence platform for air and ocean freight, and we basically source pricing data from a large number of BCOs around the globe, and we aggregate that data and provide market intel from it. But we also work with other companies to pair that pricing data in with reliability, capacity, and emission data, and so forth.
Great, thanks, Patrik. And we will get the opportunity to leverage a lot of those insights, a lot of those data, in some of the charts we'll show you here today. So let's get into it. The agenda is pretty simple. We'll talk about the outlook for next year. What do we expect? What are some of the fundamental drivers that we foresee for next year impacting the market, the supply and demand trends, and whatnot? We'll talk about rates or prices against transit times. What have we seen the past year, and what do we expect coming into next year? Then we'll talk about some of the dynamics between the fixed or contract rates against the spot or the floating market. Again, what are the deltas? What have the deltas been the past year, and what do we foresee coming into 23? Then finally, we'll wrap up with a bit of a supply and demand outlook. We've seen more capacity the past 6 months. What are we forecasting for the next year? We'll talk about that. On that note, as you can see in the visual right here, it's pretty clear that the dynamics have changed dramatically the past 6 months. We came into 2022 with way more demand than supply. In fact, 20% more. That has completely reversed, and we are now at a stage where we essentially have 20% more supply than demand out there. As usual, the devil is in the detail, trade by trade, corridor by corridor. This is the high-level global number in terms of what we're seeing here from a Flexport lens. But curious to get your perspective here, Lars. You have talked about sort of when we would see this trend reverse in the past. Did this timeline caught you by surprise? Did it, in other words, come sooner than what you had expected?
I wouldn't say it caught me by surprise. The challenge was always that the kicker was going to be when were we going to see an inventory correction. And it's always notoriously difficult to predict exactly when that was going to happen. And clearly, that trend started in September, and that's exactly what we're seeing it play out now. The play out is then also more or less as expected, and you get this almost self-fulfilling prophecy. As demand is dropping rapidly, that also means congestion is getting resolved rapidly, which leads to more capacity unleashed into a market where there's insufficient demand. And that has basically caused what in the beginning of the year was a normalization process to turn into an outright collapse in the market.
Thanks, Lars. Super insightful. Let's take a look at what's driving some of this and what will potentially continue to drive this for next year. From a Flexport perspective, we sort of foresee less consumer demand overall, less congestion, we're already seeing it, and improved schedule reliability, more blanks or voided sailing from the ocean steamship lines to essentially try and correct for the demand drop. And then these new regulations from the International Maritime Organization in terms of fuel requirements and whatnot, and then lastly, geopolitical tensions to continue. I know, Patrik, you also had another public broadcast recently where you talked about some of the same fundamentals. Would you agree with this? Anything we are missing from a Flexport perspective? How do you see it?
No, I think this is a very nice way of packaging it, and I think sort of building on to what Lars talked about on the previous chart, I think that what we've seen is really a rapid change from a seller's market to a buyer's market. If I were to sort of take a very high level look at it, that's what's happening in the market now, and it's gone much quicker than I think anybody anticipated when we started this year. Definitely,
I was at least surprised with the pace. That's for sure. Let's take a look at some of these fundamentals in more detail on the coming visuals here. So first off, what's driving some of this decline in consumer demand? I'm not a macroeconomist, and you're all reading the papers daily, so no surprise. Inflation has been at record levels. It's still at record level for North America and Europe, but we have seen some tapering off into the US. Europe, different story, but there is indeed a lag in some of these numbers. Lars and Patrik, I'm based here in sunny San Francisco, very far away from Europe. You're much closer to that. So tell me a little bit more about some of the changes and dynamics you're seeing in Europe at the moment.
I think one thing that's important to realize here is the underlying dynamics in North America and Europe are very different right now, where a large part of the inflation in the US is actually driven by a shortage of labor force, which also means if you break down the US numbers, there's very little inflation for some of the major types of goods, but you've got a lot of inflation in services. Over in Europe, you've got a very different driver because you have the whole energy and Russia crisis right on our doorstep. That is something you don't have in the US. And on the energy, again, a lot of the good old rules of thumb are out the window. The good old rule of thumb is if you head into a recession, energy prices go down, or rather oil prices go down, because we tend to think of energy as substitutable. But right now we're in the practical fix over here that energy is not substitutable. We might have enough of one energy type, but if you run out of gas in Germany, that is an issue. So we have some complicating factors here. And maybe just to tack one more comment on top of that, that is why we should be hesitant not in being too sure of exactly what consumer demand is going to be in 2023. Because the easy conclusion is we have high inflation, so consumer demand will be subdued. But if that inflation is predominantly in the service sector and not in the goods sector, we could actually end up being surprised with stronger demand than what a good old rule of thumb would tell us.
I also think that the US was much quicker in responding by jacking up the interest rates more aggressively and much quicker than what we've seen in Europe, right? And on top of that, the US is overall a stronger economy, which is what Lars is also saying. And I believe that whether this softening on the US side will continue remains to be seen, but it's more likely to be the case than what we currently believe will happen in Europe. So very different situations on both sides of the Atlantic.
How would you predict the blue line developing the next quarter or so, Patrik? It's currently hovering at the all-time high, 12% level.
Yeah, I still think it's more room there for it to either somewhat go up or flatten, because the difference when you look at what's been done with the interest rates in the US and in Europe is still so significantly far away from each other that if what's required to be done in Europe is somewhat of the equivalent of what you did in the US, then there's still more of a longer period required in order to reach that same level. So I don't see that one softening immediately, which is of course a great concern. Hopefully it will plateau or flatten quickly.
Interesting. Do you agree with that, Lars, or do you see it differently?
Well, I might just add a nuance link to partly what I also said before, because over on the US side, you have the interest rate to play with, but on the European side, we have the wild card in terms of the energy, which again is linked to partly how does the conflict with Russia play out. So we can use all the different tools we have at our disposal to combat inflation, but if the energy conflict with Russia continues to ramp up, that will also continue to add to the inflationary pressure.
Yeah, indeed. Insightful. Let's have a look at how this translates into inventory levels and inventory to sales ratios. On the graphic right here, we're showing a snapshot of North America retail inventory levels and sales to inventory ratios. You can see in the blue line that the inventory levels continue to increase and are now well above pre-pandemic levels. That's not the case yet for inventory to sales ratios in the green line, but it's well known that there's a 2-month data lag in this one. So at least from a Flexport perspective, we would expect the green line to jump in the month to come and essentially get to the same level as pre-COVID, if not even surpass that. I read in the newspaper this morning that retail even down in the month of November in North America. So that's why we're predicting some of these trends in the months to come. But curious to learn again your perspective. How do you see this one, Lars?
Yeah, I mean, you're pointing out yourself, part of this is the lag, which is one thing with the inventory levels. Another thing is how do you account for the value of the inventories when you're reporting these numbers in? Because you can also have the artifact that if I as an importer start to reduce the value of my stock before I even report it, that will also tend to lead to an underreporting of what is the physical level of the inventories. So what I would rather do is, and that's what I do every week as part of my normal business, I speak to quite a range of importers, forwarders, everybody out into the market, and it's been very, very clear for several months that there is a major inventory decline in progress. Everybody wants to get rid of excess inventory. Yep. The second thing that's also important here is, I mean, you over in Flexport provide these weekly numbers of the ocean transportation time, which has very clearly shown a massive decline over the last couple of months. And to the degree that these inventories are then included when they clear customs in the US, that means you get a lot of additional stock now coming into the inventories, which de facto has been there all along. It has been stuck on the ships, but now they're showing up physically in the warehouses. And that again is triggering the inventory correction response. So I think some of the numbers we are looking at here is perhaps not showing the full severity of the inventory overload.
Yeah, there's actually some data available on inventory levels, which is already going into November as of this year. And the slowdown on those sort of early indications in inventories of imports is somewhat unprecedented and moving very quickly back to sort of Jan, Feb, March levels of 2020. So definitely expecting inventories to be significantly reduced as we go forward in time as well, because also our customer base are reporting reductions in volumes, which it is needed to balance the inventory levels more towards what is the need to be imported.
Yeah, and maybe just to add another comment on that, I was about to say more common sense than anything else. If you look at some of the latest CTS stats at a slightly aggregated level, just Asia, Europe, Asia, North America, when volumes start dropping 25% year on year, that only happens when you have an inventory correction or a pandemic. But given that consumers haven't really stopped consuming that much, that's a very, very clear indication it is a major inventory correction we're going through.
Interesting. Lars, you talked about talking to some of your clients. Patrik, you talked about some of the data you have from some of your client reporting. Fortunately, we also have a large sample size of shippers dialed into this webinar. So why don't we just do a bit of a live survey to see how everyone here is thinking about their inventory levels. So let's do a quick poll to see what the audience feel about their inventory levels. So the options we have in terms of votes, you only get to vote on one option, is the following. So what are your current inventory levels? You have way too much, you have too much, you have what you need, you have too little, or you have way too little. Take 10-15 seconds to noodle on that one and place a vote, and then let's see what it looks like. Curious to see if this stacks up very differently than what we just heard from Patrik and Lars. That would be fun. But
hypothetically, if it does, that does not negate that you had an inventory correction. It will then tell you that potentially we're nearing the end of it.
Yeah, good point. Let's have a look. Let's see the results. Okay. What do you think? Let's start with you, Patrik. Is this surprising based on what you just said?
No, I'm surprised it was this. It basically confirms to a large extent what we just talked about, right? And doesn't make me more positive in terms of the carrier outlook, to be honest. It's not what I would want to see from a carrier perspective, because the market is already difficult for them, and by shippers, our customers, yours, etc., reporting that they basically have what they need. That's a deep concern for me in terms of the market conditions they operate with, and I will provide more nuance to that as hopefully as we go forward, because there's massive differences between trades, but the two big front hauls, Asia, Europe, Asia, US, is such a leading indicator for what comes next for these other trades that this is not a very positive outlook for them.
Yeah, I would agree. Lars, anything to add?
Not in terms of what Patrik has already outlined of the current situation. I would rather than point to something else, because I also like sometimes to be a bit optimistic and look further out. This already, almost for sure, tees up the ball for a massive resurgence in the market. Because every time you go through this inventory correction, and you do that at regular intervals, what happens once the inventories reach bottom, and especially if you have even the slightest increase in consumer demand? At that point in time, you will find all the importers suddenly find their inventories are too small. Once you're at the end of this cycle, what do they then do? They order more goods. So the ball is already teed up that at some point in the future, that then depends on the depth of recession. That's more difficult to predict. But either if you're optimistic, already peak season 23. If you're less optimistic, then you're looking lead up to Chinese New Year 24. Then you're going to see a huge surge in demand, and therefore a surge in freight rates, a recurrence again of supply chain bottlenecks, not to the degree of the last 2 years, because that was extreme, but you're still going to see a surge and new bottlenecks. The ball is already teed up for that, given what we're seeing now. So it's all a matter of domino effects. I mean, this is a bullwhip that always comes after an inventory correction.
Yeah, makes total sense. Thanks for sharing those insights too. Let's try and pivot for a moment to the trends we're seeing on transit times and price, because what is all of this adding up to when it comes to come to what you pay out there and how long time it takes. What we're showing here is the snapshot of the development from Asia to West Coast, represented by Shanghai to LA, two of the biggest ports there. And the short story here is really that we have seen both prices and transit times normalize the past 6 months down to pre-pandemic levels, 2019 and prior years. And just for the record, when we talk about transit times here, it's not just port to port transit times, it's all the way from the cargo is ready at the supplier at origin to the time the cargo leaves the destination port. But Patrik, this is the picture on like how things have panned out the past couple of years. How do you expect it to continue the next 6 months?
Well, this is an interesting picture because what's happened here is that you put pressure on the system, rates goes up and transit time goes up. Then the pressure is removed and they both come down, right? And then if you're gonna talk about what we sort of covered so far, we're basically assuming that companies have the inventories they need and consumer demand will be weak. So I anticipate the market to remain soft and remain a buyer's market for a period of time until you reach the point that Lars sort of said it's teed up to sort of bounce back, which requires us to keep an eye on what are the initiatives that the carriers are doing in order to constrain the market and flip the balance or imbalance more in their favor again, right? And that would be delaying new vessels arrival, slow steaming, rerouting, moving capacity onto other trades, which is what's going to happen on Transatlantic and then bring those rates down. So that's what we got to keep our eye on in order to figure out when is going to turn again. And that might.
When you say remain soft, let's get a bit more specific. Does that mean you expect the green line to continue at the level we're currently seeing, or could you even predict it to go lower?
Well, at this point, it's so low that if it goes lower, I would flip the whole situation to say that at some point it reach a level where it's not in the interest of the shippers or the BCO anymore. And we all remember, I guess, 2016 still, when Hanjin went bankrupt, and the amount of cost associated with that is insane. So it needs to be a sustainable market. And remember that this market has always been volatile, but just, within maybe whatever 150%, 200% increases, and not the 800 or 900% that we saw through the pandemic, right? Yeah. So I still anticipate that it will be volatile for the next 6 months as well. And the carriers tried to push through a GRI already in December and wasn't successful. They will come at that again and try to create more of an equilibrium so that they can be successful. But I believe that any GRIs coming over the next few months are going to be successful for a very short period of time, as long as the underlying market conditions are as weak as they currently are.
Lars, how do you see these rates compared to the cost of the steamship lines? Are they breaking even at these levels, or are they encountering losses?
Yeah, exactly. The challenge is always when you look at what are the carrier's unit costs, how do you calculate that? What do you include? What do you don't include? It very quickly becomes elastic band by the meter. But given that when you look at least at the Q3 results from the carriers, where as a global average, the carriers tend to be at least something like 30% higher on unit costs compared to pre-pandemic. And we now on key trades have daily spot rates that are below pre-pandemic levels. That shows them to be in very, very challenging territory. Adding to that, I would also say I would not be surprised to see your green line, the spot rate here, continue down. I would expect to see spot not bottoming out until February or March, beyond Chinese New Year. A couple of reasons for that. First of all, the fundamentals. Patrik, you're right in pointing out we should see action from the carriers. The challenge is we already have. The carriers have blanked a lot of sailings. They have canceled a lot of sailings. But it's not enough. I mean, on Asia-Europe, if I look at all month of December, we still operate the same amount of capacity as last year. despite all the blank sailings. Asia to US West Coast specifically, for all of December, there's 15% more capacity than last year in a market where demand is down 20+%. So the actions taken by the carriers is wholly insufficient. So there's nothing to say that the rates are going to stop anytime soon. Historically, the carriers would tend to hit a hard floor when they really become cash negative on the rates, because there was a limit as to how long you would last. Hanjin was a very clear example of that. But that's not the case right now. I mean, let's be honest here. The carriers are all sitting on massive piles of cash, which means all bets are off in terms of how deep can this go before it bounces back. It will bounce back, but all bets are off right now in terms of how hard a landing are we going to see.
I actually agree with that, to be honest, Lars. I do want to say, however, that history has learned us one thing, that there's a constant line of curveballs that comes our way in this industry. And, you know, empty containers are now piling up in Chinese ports. Mm-hmm. Boxes are already being reported stacked on roads, and some ports report 90% of box spaces occupied.
In Arizona, they have built a literal wall to Mexico with empty containers.
So, and this is what I mean. So every time I'm challenged to sort of predict the market, I think, what are the indicators we can look at as to when does it flip in either direction? And what are the surprises that might hit us, whether it's, you know, COVID, fires in Australia, or Ukraine, Taiwan. It's an endless line of events. It can be as basic as Ever Given blocking the Suez Canal, right? And all of a sudden we talk about something very, very different.
Mm-hmm. Yeah. No, absolutely. You can say maybe to add to that one indication also to look up for. I mean, I was mentioning before, one of the things that we could be optimistic and we might see a bounce already during peak season 23, or it might be longer. From my perspective, one of the things to look out for are carrier reactions. Because for now, I would still expect carriers to just idle vessels, have them lay at anchor outside Singapore or wherever. The moment you start to see carriers put vessels into cold layup, that is also an indication that the carriers get using from their customers that this is going to be a prolonged downturn. So that's one thing to also keep an eye out for. Last time we saw that, of course, was during the financial crisis. And if you look at the stats, the downturn, at least the pace of the downturn right now, matches what we saw in the financial crisis.
Yeah, good points. Let's take a look at some of the other markets, because this is the story for Asia to West Coast. Slightly different picture we are seeing into the East Coast. Rates have come down close to 2019 pre-pandemic levels by now. But transit time, that's a different story. Lars, why is that? Help us understand this.
Yeah, this is basically a domino effect of the massive vessel pileup off of California in the beginning of the year. That caused a lot of shippers to shift their supply chains to the US East Coast, and lo and behold, they became congested. So it's simply the domino effect of that. And you could then say, well, why aren't they shifting back? Because there is no more a lineup in California. The answer to that is everybody is holding their breath to see what is the union going to do. Are we going to see labor actions? Very round numbers. Prior to all of this pandemic hoo-ha, it was a 2-to-1. So on the Transpac, 2 containers went to the West Coast, 1 container went to the East Coast. And very round numbers, it's now 1-to-1. So this is why the East Coast became enormously challenged. If, let's say, hypothetically tomorrow there was a new deal with the ILWU, you would see a lot of this shift back to the US West Coast, and this spread you have right now between East Coast and West Coast rates would also come down right quick.
Talking about ILWU, what's your latest prediction on how that's going to land, Lars, and the negotiation?
I don't necessarily envision an all-out strike, but I think there is by now a very high risk you're going to see the same play out as in 2015, which means that you're going to see labor actions of going slow. Back in the middle of the year, the indication was that we would not get a strike because there was too much pressure on all parties not to make a bad situation worse. And that's exactly what happened. The challenge is now we're basically a half a year down the road, and there are 2 new curveballs coming in. Half a year ago, you could have argued that the terminals, and therefore by extension the carriers, could have thrown money at the problem, offer the union a massive pay hike to accept basically automation. That's part of the issue. Nobody's going to offer a lot of money in the current environment. Absolutely not. Secondly, you have a turf war going on now between the Port Workers Union, the ILWU, and the Machinists Union over who then gets the prerogative when you get more automation of actually fixing the automated equipment. So it's now more difficult to reach an agreement than it was 6 months ago.
Would you agree with that, Patrik?
I think this sums it up fairly well. Yeah, and I mean that's another one example of these curveballs that, you know, worst case it could have an influence on the prices or the transit times as well, and change the picture.
If the delays and it could add to congestion.
Exactly, and you can say this is where all these domino effects tend to come in, because you have the very good slide here on US East Coast, which is a consequence of the West Coast. And this is also why Atlantic rates are still historically high, because all the Atlantic vessels got trapped in this US East Coast congestion.
And I'd add to that actually that given the strengthening of the dollar, it's been cheaper for the US businesses to trade with Europe as well. So we've seen an increase in volume on the Transatlantic as well, which is pushing up this trade as you pull up here. But this is also just temporarily in my mind, because when we entered the pandemic and we started to see the different trades skyrocket, that also came in a certain sequence, right? And then you start shifting capacity to the trades that yields better, more favorable returns, right? And that's what we're going to see on the way down as well. That some move first and then others follow as they get more capacity injected.
Yeah, and you can say from a carrier perspective, now that you've got surplus capacity, the easy thing is let's put more capacity into the Atlantic. And again, when I look at December numbers, North Atlantic, we're looking at a 30% capacity injection. South Atlantic, you're looking at 45% capacity injection. So the party is over, basically, for anybody looking for high rates on the transatlantic. If you're a shipper, that is great. There are more normal times coming around the corner.
Yeah, I would also say that the carriers have a little bit more time, because, you know, when we saw the spot market sort of skyrocketing, it takes like a good 6 months before the contract market sort of picks up and sees some of the same increases, but not to the same extent. And vice versa, they sort of managed to reach a peak when the swap market collapsed below them, and now we will start to see drops in the long-term market over the next 6 months as well, which means the profitability of the carriers are still going to be quite healthy for a period of time into the future, and that's sort of further strengthened their financial muscles to, you know, live through this situation to reach the state that Lars explained, where it can go back up again.
Yeah, I would agree with that. I think what we've seen is the most corrections on the key east-west trades, namely Trans-Pacific and Asia-Europe. Transatlantic is up next. It's already happening, as we can see here. And then comes the north-south trades. And that's, to both of your points, also what we've seen in the history books. That's the typical pattern. But let's take a look at Asia-Europe for a moment. Here we're seeing the numbers from one of the key lanes, Shanghai to Rotterdam. Prices have come down. Transit times not quite yet. Patrik, why is that? What are some of the fundamentals and the laggers there relative to the other trades?
Yeah, it's been congestion issues in Europe as well, and I have the same expectations here that over the next few months we will see that calm down as well, and that they all sort of follow the same pattern. But the reason for that is again bottlenecks in the ports in Europe as well that has caused this prolonged transit time period. Especially, I think Hamburg has been hit more recently with issues.
Yeah, I would tend to add there is a potential added element here going forward that we don't see over on the Pacific part, because the moment you're looking Asia to North Europe in particular, I mean, this is the only place you can use the ultra-large container vessels. And the Asia-Europe trade has been underwater longer now than the Pacific trade. So there isn't really any other place to put the vessels. So the carrier's choice is, are you going to anchor them up somewhere, or are you going to go even slower? And that's why I'm not necessarily positive that we will go back to the same transit times we were used to. You can easily see a scenario where transit times will continue to be somewhat prolonged, simply because the carriers are going to slow them down to use the vessels for something.
Yeah.
Now, you're of course measuring the head haul here, but you're right now seeing on the back haul already more than a dozen vessels go around Africa at the moment.
Yeah, I was just going to say, yeah. That's perfect, Lars. I think that's a beautiful example of carriers being willing to extend the transit times and just go slower in order to try and put the brakes on. And
put the brakes on, but you can say in that mean again, if we are to learn from history, the next thing that's going to happen is that the Suez Canal authorities will first deny that this happens, and the second thing is then they will offer a discount if you go through the canal with these vessels to again entice the carriers to make sure they go through the canal.
Yeah, a lot of things we can learn from history. Shows again and again. Okay, let's pivot to the mix between floating and fixed or contract rates. It's pretty clear that what we've seen on the Trans-Pacific into East Coast and West Coast, for that matter, that spot rates are far below the contract rates that were signed up at the mid of 2022. Same story for Asia Europe, but different story on the Transatlantic. So everything going from North Europe to East Coast, basically back to the previous chart we just saw. Fixed rates are still in line with the spot rates out there. Patrik, what are you seeing? You have a lot of real-time insight from your database in terms of fixed versus floating rates, even quarterly rates and all that good stuff. What are you seeing in terms of fixed rates being signed up at the moment on Asia, Europe, Trans-Pacific, and whatnot, relative to the numbers we see up here on the screen?
Well, in all cases, it's coming down significantly, right? And to give you an example, on Far East to US West Coast, the average 2023 long-term rates that we're now seeing coming in sits right around $3,000, but there's a spread where the lower end, and that's not the bottom end, but the lower end is dipping right below $2,000 for long-term contracts. But on the other side, the higher end of that sits as high as 6,000, right? But even with that taken into consideration, the long term for the entire market relative to where it was in the beginning of this year is coming down, right? So everybody's seeing reductions. Some are seeing significantly more than others, and I believe it's those who's sort of gone on an early tender cycle that is securing now sort of their final bids and rates for 2023. And those who goes later might see even further reductions if the spot market remains as low or moves even further down. Now, what's different for 2023 is that a lot more of the large volume BCOs either reduce their contract cycle from 12, which is the usual standard, but keep in mind going through COVID, we saw an historical amount of 2-year rates, right? So when the market went up, the willingness to go longer came into play, and now it's reversed. Now we see BCOs going from 12 to 6 in order to be able to be in a position halfway through next year to renegotiate again, because they're too concerned that they're losing out too much money by contracting now. And there's too much internal pressure on these procurement people that if the market stays low or drops off even further, the premium they're paying for the choices they made is not something that they can live with. So I believe there's a lot of uncertainty and to some degree some fear that comes into play here for those who goes to market now and secure these long-term contracts. But overall, significant reductions already in for 2023 on the contract market.
So what you're saying, Patrik, just to make sure I get it right, if we take the Asia to West Coast, the left chart right here as an example, and look at the green line, basically what was signed up at the bid season, the tender season last year was hovering around what we see here. You were basically saying that is now dropping to an average of half of what we see here, so $3,000 per 40 or something. Is that what you're saying?
Half of it, and 1/3 of it, below 1/3 for the lower end, and that's that's the ones who's gone sort of early, right? And that's what I mean. And you know this as well, there's a lot of long-term contracts that are about to expire as we go into the new year, and a lot of new long-term contracts will come into play in April and May for that trade specifically. And that's where we will see finally where sort of 2023 rates settle for this corridor.
Insightful. How about the terms of signing up some of these fixed contracts? Pricing aside, there's a lot more to it in terms of is it enforceable or not. I think we saw a lot of new enforceable contracts being signed up the past couple of years because everyone was desperate to just get space. So a lot of debt freight terms, weekly fixed numbers, and whatnot was being signed up out there. What have you seen when talking to clients out there, Lars? How has that all been shaking out? Are those fixed contracts still in place? Are people honoring them? What's going to happen in the future?
Yeah, there's a great deal of variability out there. You can say the good old-fashioned traditional contract, that's playing out, I was about to say, exactly as we've seen a million times before. There's been plenty of contract renegotiations over the last couple of months with what was ostensibly an annual contract going to lower rates. And mind you, in some of these cases, it has not been the shipper that went to the carrier to renegotiate. We've seen cases of carriers proactively offering their shippers lower rates on the contracts to amend the contract. That also tells you something about the weakness in the market. When it comes to the more enforceable contract types out there, there's a couple of different things that are playing out there. First of all, you can say there's the approach where if I have to pay a penalty of, let's say, $1,000 for not delivering a container, under normal circumstances, that would certainly deter me from breaking that contract. But if spot rates are suddenly $5,000 below my contract, I would be happy to pay $1,000 to get rid of that volume, right? So in theory, that is enforceable, but enforceable does not necessarily mean that you get all the volume moved at the agreed rates. You just get that penalty. The carrier gets some buffer against part of the decline, and the contract is enforceable. It just doesn't mean what people think. I've also seen other models out there of carriers recognizing, okay, you have an enforceable contract, you agreed on giving us X volume, but we know the market is down. We know that you're only in total shipping half of what you thought. So as long as you then also give us half of what you promised us, we will take it as good faith and you're living up to the contract. So this is very much a lot of the commercial negotiations that are going on out in the market as well.
I can add to that a month and a half ago, we hosted our annual Xeneta Customer Summit, and the amount of grudge, the amount of resentment from the BCOs in terms of, the market is softening, I'm going to stick it back to them now because it was a nightmare when the market exploded. So even though you have that concept of forcible contracts, it doesn't work out because it's a customer supplier relationship that, in the interest of the supplier, when the market drops like this, they have to make a move towards their customer in order to try and retain some of the business. So there is so many, how can I say this politically correct, the unhealthy dynamics that is playing out between them, which sort of stems from decades of distrust when in terms of how they treat each other when the market goes up and down. So I see this to be a real conundrum for the industry, but it's very hard to work around. And now that we're in such a favorable buyer's market, whether it's the mechanism Lars mentioned here or not, the carriers needs to make adjustments, even though they have a locked-in contract at a much higher level.
Yeah, you can say part of what I also see out there is just a good old-fashioned. I mean, I'm not going to blame either the shippers or the carriers for breaking contracts because this has just been a continuing cycle for decades. This is the umpteenth time we're seeing this. What I do sense out there is there's a little bit of nuance because, I mean, if we are not politically correct, you can say, well, all the carriers stabbed a number of customers in the back over the last 2 years like you would normally see in this cycle. But they were not equally aggressive about doing it. And what comes around goes around. I also see a nuance among some of the shippers out there that they are more angry at some carriers than they are at other carriers. There are nuances there as well.
Yep.
Super insightful. There's definitely a lot of negotiation going on out there. That's for sure. Patrik, you mentioned the buyer's market. So on that note, let's do another poll. Let's hear from the audience, many of the shippers, how they expect to essentially allocate their volumes on fixed contracts versus the spot market. With the market we have in front of us. So to all of you out there, based on your experiences over the last couple of years and your predictions for the future, plus what we're hearing here from the panel, do you plan to sign more or less volume on fixed contracts going forward? You have three options. Pick one, and then we'll see the outcome in a second. Lars, Patrik, any bets on the distribution here before we see the results?
No, I mean, my expectation would definitely be less, because you had a lot that went to contract here in the beginning part of 22 simply to hedge their bets, because nobody knew, was the market going to crash at the end of 22, or was this not going to happen until 23?
I think it depends a little bit how you interpret this question, to be honest, because if I was a BZO, I would say that for now, I'm going to commit as little as possible until I feel we're sort of close to the end, and then I'm going to tie in much more at that point, right? So my response here would be less first, then more, right? And yeah.
Let's see
Yeah.
what the audience say.
Yeah.
That was in line. 54% less, 15% more, and 30% is changing as we speak. Same. But I think it's kind of like hard to answer this question if you don't know what the price is, right? Because if the price is zero, you probably sign up more fixed contracts. If the price is 10,000, probably less. It kind of like goes hand.
You're going to turn that one around and say, I mean, if any BCO, I mean, let's just go with your example. Fine, you can get zero base rate then plus whatever surcharges. If you sign up an annual contract at that level, you're also teeing yourself up for a failure as a supply chain manager, because the moment the market increases even slightly, you got zero chance of moving any physical freight on that contract.
I think the biggest surprise here is the 33% on same, which, you know, to some degree, you can argue that there are quite a lot of shippers out there who's not that price sensitive, right? And are more concerned about supply chain stability and you know, making sure the goods are moved. So that's interesting from my point of view.
Yeah, let's have a look at the next poll where we have baked in some potential price levels to see how the outcome is against that question. So if we look at this one, as spot rates have already approached 2019 levels, in some cases at carrier loss-making levels on the East-West trades, Asia-Europe and Trans-Pacific, what would the maximum rate you would pay on those two lanes to sign up a fixed contract? We know it's very low. So is it up to 70% higher than the current spot rate? Is it up to 50% higher than the current spot rate? Up to 30% higher? Is it same or lower than the current spot rates we saw a minute ago on Trans-Pacific and Asia-Europe? Or would you rather ride the spot market and then just bank on getting the capacity you need at the floating rates? Pick one of the five here. I'm going to be curious to see this one. Let's get another betting contest going. Patrik, which one do you think gets the most vote?
Again, a bit of a trick question, I must admit, because if you think about the front haul into US from Asia, right? My response would be same or lower than the current spot, right? Or up to 30% higher, right? I would be on those two options. But Transatlantic is still up on the spot market 257% compared to when the pandemic started. So in that market, I would ride the spot market instead until I see that decline that we're anticipating. Same as we discussed when the market went off, this trade will also calm down. So that would be my response.
Unless you, of course, get a very, very attractive transatlantic rate that is lower than the current spot market.
Yeah, 100% agree. The only thing I want to add is that when we look at the lower end of the spot market on transatlantic, that one has already fallen off a cliff. And the increase on the low end is only 162% since pre-pandemic. So already very strong signals that I will get that reduction and I would benefit from holding off if I could choose.
Fair. Let's see the results. Interesting. Lars, is it surprising?
No, it's not really surprising. And again, why would you go out and negotiate an annual contract right now if you can wait a month or two until after Chinese New Year, where you might be likely to get an even lower rate? But again, with the caveat, as I mentioned before, if you go too low and you get a rebound in peak season, you're going to be hard pressed to get space.
Very good point. Okay, insightful results we're seeing right here. We'll make sure to share that content so you all have it available in case you couldn't memorize all the stats right there. Let's get back to the deck here. We have shy of 10 minutes left, so let's try and see if we can wrap it up on a high. We already talked about some of these hotspots here throughout the other visuals. But anything you want to add? If we start with you, Lars, on some of the hotspots we have depicted on the world map right here.
No, I mean, I think you're going to see the hotspots turn less and less hot here, and that happens fairly quickly. I mean, it works wonders if you don't have to move a lot of cargo through the bottlenecks. So that's going to work out real well. I would rather than say what are then the potential hotspots. We already talked about the U.S. West Coast. That is a major risk that could flare up again. But if you look just slightly ahead, I would also tend to look to maybe not the largest, but in secondary ports around Southeast Asia. Because increasingly and more rapidly, you're seeing importers shift to now it's popularly called the China Plus One strategy. Still producing in China, but you're trying to shift some of it somewhere else. And if you move to other places in Southeast Asia, if that happens a little bit too quickly, it's not going to draw down production that much in China. But if you move it to a place with a secondary port in Southeast Asia, you could quickly overwhelm some of the port infrastructure in those secondary locations. And therefore, you could get hotspots across Asia.
Got it. But as a rule of thumb, you're saying we actually picked the right color coding for the hotspots. They may be hot and red now, but they're turning green slowly but steady. Is that what you're saying?
That's basically it. I mean, if I was to add one other potential risk, that is more down to what we've already seen over the last 6 months. I would not rule out that you would get more strike action from port workers throughout Europe, as I mean, a lot of the countries are also heavily unionized and they're going to demand to be compensated for the inflationary pressure.
Makes sense. Okay, let's look at schedule reliability. That's improving. It's a positive, but it's also a clear call out that I think no one can be satisfied with a 52% schedule reliability, right? Even if we look back at 2019 levels, it was hovering around 80%. That's pretty far away from some of the fast-moving consumer goods services you get from online retailers and whatnot out there. Patrik, how do you see this developing next year? Are we going to get back to 2019 levels? Could you even foresee the graph going higher than that? What do you think?
Well, I think that as long as the pressure is taken out of the system, this will continue to climb as soon as things stabilizes a bit more. So anticipate plus 70% for sure.
Same, Lars.
Yeah, I would assume exactly. I mean, my expectation is bottleneck problems are in the main, barring the US West Coast, but then they're in the main going to be solved by the end of first quarter. And that also means reliability is going to come back to typically it's in the range between 70 and 80%, has been that for a decade, and that's what we're going to get back to.
Yeah, I would agree. Okay, the supply outlook in terms of influx of vessels hitting the seas is staggering. You can see next year that the order book that is expected to be delivered to the market is accounting for 9% of the total fleet size, which is significant, and even more to come in 24. Lars, how do you see this? Do you think that the carriers will shave off parts of the green by essentially pushing back some of the deliverables to adjust supply and demand, or what do you?
No, there's a different mechanism here. First of all, you're going to see a raft of scrapping here. That's not going to solve the problem, but it's going to take the edge off the problem. You could potentially have, say, 2, if you're really aggressive, 3 percentage points taken off in 23 from scrapping, but no more than that, which still leaves you with capacity injection far higher than what demand is going to be. Then you have a major wild card in terms of the environmental rules, which, depending on where you look, is anywhere between 0 and up to 10 to 15% of capacity that over the full course of those 2 years is effectively going to be taken out due to slow steaming. And I find it fantastic that we're just 2 weeks away from IMO 2023, and there's still no good handle on exactly what is this going to mean for the ships. But hey, that's where we are. But even if we take all of these effects into account, there's still going to be too much capacity delivered over the next couple of years, no matter how you slice and dice it. And that's where I tend to see this one slightly differently. We've been so used to the pandemic, but the pandemic is unusual. What we're seeing here is a completely normal cyclical downturn that you would see any time after a cyclical upturn. So that's more the perspective I see what we're heading into here. This is a normal cyclical downturn. The market will gradually weaken here over 23, 24, and then you're going to set the stage for another cyclical upturn, which will then peak somewhere around 26 or 27, all else equal.
I would agree with that. We haven't forecasted that far into the future. Here we've just taken a snapshot of the Flexport view the next year, where we would essentially expect the supply-demand gap to remain or even increase in some cases. As always, the devil's in the detail, trade by trade, corridor by corridor. But Patrik, to wrap us up, is that also how you see it, or any tweaks?
I would just like to point out something that I find incredibly fascinating, that going through the pandemic, the carriers, they learned how to make money, right? It's you squeeze capacity relative to demand and the rates skyrocket. It's very basic economics, right? And the fact that we're debating that they will allow this to happen, this oversupply in the market, is almost bizarre, right? Because these are businesses that are, built to make money, and they are 10 of them that control, 90% of the global deep sea market. It's such, and they're in 3 alliances, right? That the fact that they can't control this market over the next couple of years from a supply side is hard to understand. Just the basics of it. I understand it's a challenging market and all of that, but all you need to ensure is that you gotta make sure that it's too little supply versus demand. So again, I do see that we expect this to happen, and I share the view, but I'm still, just from the pure fundamentals, a bit surprised.
Yeah, it sounds simple, but it is not. It is a lot of coordination, even in the 3 big alliances and whatnot.
Yeah.
Sure. On that note, let's wrap up before everyone probably have other commitments. Thanks for listening in, as always. Please reach out to Lars, Patrik, myself with any feedback, questions. We'll share the content, and have a great rest of your day.
Thank you for inviting us.